Hey, Kathy, thanks so much for taking out the time today to chat with us.
Thanks for having me.
Yeah, I've listened to you for a long time. I know you through Bigger Pockets and stuff like that, and I wanted to get you on because you have a lot of knowledge and you've been in the market for a long time. So I believe you provide a lot of value to a lot of investors, and would love to, dig in on a couple of things in particular with the market and everything else. But before we do, if you can kind of bring everybody that all my listeners up to speed on who you are and what you're doing today.
Yeah, I'm the founder of Real Wealth. I started the company in 2003. So this is last year was our 20-year anniversary. I started it because I'm from California and wanted to invest in real estate and could just not figure out how to do that in California. So I had to learn how to find good markets that cash flow, where we could invest out of state and not be able to see our property. So that's what we did, and we've been helping thousands of investors do that for the past 20 years. And then I also host the Real Wealth Show podcast and wrote a book called Retire Rich with Rentals.
Nice. You and your husband have been doing this for the same time, right?
Yeah, he really came in around 2008 to help me because I grew it faster than I knew how to handle. We're actually writing a book on that right now for Bigger Pockets on how to grow your business sustainably. People like me who are starters and have great business ideas don't necessarily know how to maintain a business or hire people or manage people. So he came in around 2008 to help. But yeah, we bought our first property in 97 together, turned it into a fourplex. So we've been investing together for, what is that, 26, 27 years?
That's awesome. Yeah, well, first, before getting into your story, I would like to hear a little bit about, how you two have been, because a lot of people, talk about, how to get their spouse on board, and not so much to get them on board, but to see the same vision. And so you've been doing it since 2003, at least running the company, not, investing. And then he came in 5 years later. So what makes it a good partnership, if you will, between spouses, and how have you two been so successful at that?
Well, we did speak about this at the Bigger Pockets event at the BPCon. How to invest with your spouse, how to run a business with your spouse is definitely next level relationship, right? It requires an enormous amount of self-awareness and communication skills, but that's really required for a good marriage anyway. In our case, what we found over the years is that opposites attract, and that's the thing that just really, creates the fireworks. But then after you've been married for a while, those differences can kind of drive you crazy. So we
Yeah.
have to remember, what was it about this person that I loved so much at the beginning? And it is those differences and being able to understand it, and how those differences actually add to our lives and kind of complete the circle, so to speak. They have something we don't have. For a more tangible, I guess, explanation, the first investment property that we bought, I didn't even tell him about it because I was scared he would say no. That was an example of bad communication.
Mhm.
He was risk averse. He didn't want to manage a property from afar. And I just thought, well, the only way I'm going to get this done is if I just do it and tell him about it later. Not great for a marriage. That kind of led to discussion of like, well, why couldn't you tell me? And how could we do this together? And how I would have said yes if you gave me enough information, that type of thing. So we learned over time that he's a detail person
Yeah.
and I'm a jump in and do it person. And we need each other
Yeah.
because, you could have analysis paralysis. He would maybe never own any real estate if it weren't for me. And I would own a bunch of garbage real estate if I didn't have him, because he could really sit down with me and run the numbers. So, understanding each other's strengths and how you can help each other and being open to that, because that's the next phase. If you're a super analyst, you might not ever take the plunge and get nowhere.
Yeah.
So yeah, being able to really listen to each other, give each other what each other needs, and there's got to be some ability to take risk in there too.
Yeah. No, I agree. Risk, and then just have, even if one person or the other doesn't have the exact same vision, really mold that into a vision that can be compatible for two people. Just like business partners and everything else. But like you said, you got to have that communication and also kinship throughout just a relationship, but to bring that in full circle. So you guys bought your first place 97, and then moving forward, you started this company 03 or started helping investors. Well, when you bought that first one, for one, is most of your stuff in California or is it outside of California?
Our first investment was in California. It was a big house that we house hacked. We turned it into a fourplex and lived in, the main part of it and rented out 3 different spaces. And that really covered our rent. So, or our mortgage, I should say.
Yeah.
So that was the first time we kind of learned how to manage tenants. We had friends living there, so it was really fun. It wasn't just strangers. So it wasn't like fully being a landlord.
Yeah.
But the first time that we owned an investment property that was just that was, like I said, not until about 6 years later, 2003, when I jumped on a plane and went to Dallas, Texas, because I'd interviewed Robert Kiyosaki on the Real Wealth Show, and he
Okay.
explained how California real estate was, it couldn't cash flow. It was very difficult to have a cash flow, but that there were other parts of the country where there was job growth, population growth, and yet there was cash flow.
Yeah.
You could cash flow while the appreciation was happening instead of just waiting for appreciation, which is what you do in California.
Yeah. Wait for appreciation, and then cash flow will follow 3 to 5 years later.
Or 10.
Or 10. Yeah, depending on where you're buying, especially on the coast. So, okay, when you look at that and then you move forward with, being an investor that is out of state and trying to find a market, and I know you've talked about this in length, but trying to find a market that is going to suit you for what you're looking for. I mean, a lot of people just say cash flow, and like you said, appreciation. But can you give me a couple of examples of how you started to feel comfortable on investing out of state? Because that's usually, I have a lot of people that come to me and say, I live in California too. They say, hey, I want to invest out of state. And then all of a sudden they revert back because they want something tangible, if you will, 30-minute drive, 60-minute drive from them versus, a 2-hour, 3-hour flight.
Yeah, it is scary. We owned a rental property that was just a couple of miles from our house, and we literally never went to it. We still sent handyman, like inspectors and so forth. So we realized it's really not that different unless you do the work yourself. But if you're doing the work yourself, you got to kind of ask yourself how much your time is worth. We got into a point where we could hire people to do the fix-up stuff that we could do, but that we make a higher hourly wage. So why would we take the time? We would hire someone else and spend our time making more money doing the things that we can do to make more money.
Yeah.
So we just kind of learned that, like any business, you shouldn't be doing all the roles, even if you can. Even if you can, you got to learn how to trust people, to hire people, to train people. That's the only way you can scale. It's the only way you can grow. So that's first and foremost, is if you're going to run a business, and you're never going to get rich off one property. So, unless it's just a home run, but you need a portfolio, and that means it is a business and it has to be run like a business. And you can't do it all. I know some of the old time landlords did, they might still own properties in their own neighborhood, and they kind of do everything. And that's fine if that's your full-time job and you love it. But it wasn't ours. We didn't like fixing things and getting our hands dirty and so forth. So for us, it really just wasn't that different. It's like, just build a team. Build a team. And, we have, I would say, starting my investing career in 2003 out of state, the timing was great because we were starting to get more technologies that make that easier. Obviously, before the internet, before Google Maps and all that, it would have been definitely scarier. You just would have no idea what's going on. I'm sure people did it, but when you can, when the world becomes a lot smaller with all the technologies that we have, so the timing was right for us, and it's even better today, right? There's so many tools and technologies to help you manage your portfolios wherever they are. But for us to get over it, it was like going there. we spent, well, I personally, would spend weeks just meeting with property managers, learning neighborhoods. I went to Dallas because that's what Robert Kiyosaki said was the next up and coming place. He was right. It was super cheap when we went, but we could see the growth coming. All the, freeway expansions and businesses moving there, even back in 2003, it just made sense. But for us to get comfortable, we just needed to go and walk the streets and meet the neighbors and pick out the property and walk through it. And that at that time, a new home was like $130,000 and it rented for $1,500. So like, why get an old one when we could just get a new one that we wouldn't have to worry about? Everything was under warranty. So that was part of how we were able to get over the fear. And then once we knew the areas and had our property management team and tested them and had like I said, the mortgage broker and the agent and the repair people and all of that in place, then we were able to buy subsequent properties without going. All we needed was the paperwork, the inspection. You can hire you should hire third party inspectors to tell you what you got.
Yeah.
And when you're buying a new home, again, we were, kind of just focused on that because that was easier at the time. And it really honestly is.
Yeah.
Then you have a kind of like a year warranty usually. And so you could get your inspection a year after you own it, after you've rented it, and they'll still come in and repair things, so there's a lot of benefits. That was kind of how it worked for us.
Well, and you picked out one good thing and outside of all the other good things you talked about, but one is, expansion, growth, increase in population. Those are, big things to look at, especially when you're going outside of, an area that you know. So if you go outside that area, start looking at those data points, and, really dig in on that. And I want to follow up on, you talked about property management and stuff like that. That's such a big, challenge, especially the farther you are away. You don't know, for one, the comfort level. Okay, well, I need to know that person that's going to really manage my properties, and the expectations are going to be high. So how did you, for one, did you go through a lot of property management companies? And two, how did you get to a point where you said, okay, hey, this is what I'm looking for, and I'm not going to, really lower my standards?
I ended up, like I said, when I first flew to Dallas, I just hired a realtor. Somebody recommended. And the first thing she said when I got off the plane was, oh, you're from California. Let me take you to this neighborhood that Californians like. And I asked her about it, and the properties were about $400,000. I knew that the median home price in Dallas was $140,000. I had done my research, so I knew that she was just trying to get a good commission check. And that, yeah, sure, maybe Californians would move to that area because $400,000 for a new, for a home is cheap for a Californian, but that's not cheap for a rental property, especially in Dallas.
Yeah.
But we learned right away that probably the real estate agent wasn't our best resource. We probably needed to find somebody who would be more honest with us, and it just made sense as the property manager. They're the ones that have to manage this. This new puppy, basically. They're the ones that have to take care of it. So they'll give you better information. So I just every single day I'd meet with a new property manager until I found one where I could see that they had systems in place. They had experience. They owned a large or they managed a large portfolio, but not too large. I'd want to know, how do you handle evictions? How many people do you have on staff, and how many properties does each staff person manage? Just really understanding it, like you said, going into their offices. And you could see instantly when you go into someone's office, you could see how they operate. Yes. And there'd be some with just piles and piles of folders on their desk, and there'd be others with, back then it was filing cabinets, but they were organized. Yeah. And they had systems, and the chalkboards, and you could just tell. And also the property managers would tell us, where the calls were coming in. There was one that had a map that would show where the most desired neighborhoods were, where they were getting the most phone calls, where people wanted to live. And they would explain, they'd research that and find out why. Maybe there was a new business moving into that area, or there was just nicer homes or whatever. They could tell us where that rental demand was and what rents were going for, versus a real estate agent that might oftentimes just guess, which they shouldn't. I actually think that's not even That's a DRE regulation, that they shouldn't be guessing on what rents would come in at. But I've had that happen a lot. So a property manager will really know because they're dealing with it every day.
Yeah. Dealing with it every day, having those conversations with tenants, and then also, getting all their data.
Yeah.
Where did they move here? Did they just, start, a new job and everything else that that job's gonna say, okay, hey, yeah, it's IBM. They just put, a huge factory and they're hiring a bunch of people, or they're, laying off a bunch of people. They're gonna know the real time, to date what's going on, which is really good. And then also you gave some good tips, like how many people are on staff. Go into their office where you can see, okay, this person's squared away and this person's not. All really good tips. So moving forward along your journey, especially growing the business and everything else, let's talk a little bit about, we don't have to dig into it too much. I know this is another thing you've really talked about a lot, is 2008, but how were you guys able to weather that storm and getting through it? What type of 1 to 2 takeaways from it?
We got completely wiped out in 2008, but our company didn't, because I was doing something different than what I was teaching. And that is something I just kind of laugh at to these days, even though it was very difficult at the time. But I was teaching people and showing people and helping people sell their California high priced property, because it became very obvious by 2006, 2007 that California was in a bubble, and it was all based on these bad loans, and these loans would come due and people wouldn't be able to pay them and there would be a mess. That wasn't the case in Texas. The mortgages were still really affordable, and they had much stricter lending laws there, and it was just so much cheaper than the average home price, even though jobs were coming and wages were increasing. So all the fundamentals were in Texas. So I helped so many people get out of California, sell California, 1031 exchange, and get like 10 properties after selling just one. It was like it changed their lives overnight. It was crazy. I did that. We had 12 or 14 properties in Dallas and in other areas, but we had a couple of homes. There was a home I grew up in, but I raised my kids in, that we turned into a rental, the one that we had house hacked.
Yeah.
We ended up just renting that out, but it was it was like a $1.5 million property. By 2008, that was worth 800,000. But we had taken so many cash out refinances because we would take that money and go buy property, that we were stuck with a $1.1 million loan on a property that was worth 800. And then that tenant wasn't able to pay. It was a big mess. Then we also bought a couple of properties in Tennessee. I had told people on the Real Well show, I was speaking at live events saying never get a loan that balloons. So I was a mortgage broker at the time. I knew that a balloon note, it means that when that loan is due, it's due.
Yes.
And on construction loans, you get the construction loan, then it's due after a year and you have to find a new loan. Well, we did like 3 construction loans in Tennessee, and I thought I had got a construction to perm, but I didn't read the fine print, and it was just construction and a balloon. So when 2008 happened and the banks failed, and all of a sudden there were new regulations where you couldn't get more than 10 investor loans, we were way past that. So we could not refinance. There was no bank that would refinance us out of these construction loans. So they ballooned, and we had to come up with, I don't know, $800,000 cash or something. We didn't have it. So we had to pay those properties back to the bank, lost all our money. We found out later that Tennessee had all these regulations. They could have potentially put us in jail for not paying our debt. I mean, it was just like, it was a nightmare. So anyway, we learned a lot from that time period. So we got wiped out while we helped thousands of investors not get wiped out. In fact, the investors that we helped, not only did they sell their properties in California at the peak and then 1031 it into Dallas, that was at the beginning of its boom. So they did not lose anything. They got all their capital and then invested it, and then that grew more.
Yeah.
We kind of did the opposite. So lots of lessons learned.
Yeah. Well, I mean, you are, one story of many that went through that, that, had a lot of lessons ultimately, especially if you're in real estate. I was not at the time, but within real estate that, had been in the market for a long time, but still, got hit really hard. So moving out of that 2008 and going into, early, 2013, 2014, what, when regulations changed and everything else, like what did the business look like then? And then fast forward to now, how are you guys, different, structured differently, and how are you helping clients differently?
Well, things turned around for me literally in 2009. Like we got hit hard in 2008. And then 2009 is when I started to look around and was like, oh my gosh, there's stuff for 10 cents on the dollar. This is insane. But my credit was shot, right? Because we had to give those properties back to the bank. So I couldn't use my own credit. It was right around then that a developer heard my show. And it was really a weird thing to be a well-known podcast host and have all this going on. It was like a really challenging time. But
Yeah,
still, this developer heard my show and he said, I can pick up subdivisions that have been foreclosed on for 10 cents on the dollar. We can finish them out. That you just can't lose money on that when you're buying that cheap.
yeah,
I thought, okay, well, he said, I can buy these things. I'm just walking into B of A. There's hallways lined with boxes full of foreclosed everything. Can
hmm,
you raise money? And I said, I don't know. And he's like, well, let's partner. And I've got a deal in Portland where we can, these 27 townhomes, waterfront, went to foreclosure. And he said, we could buy them for 3 million, all of them for 3 million. The value was about 20 million.
yeah,
So that was my first syndication. I kind of reached out to our list, and it turns out we I was able to raise the money in like an hour, for $3 million to buy those. Those investors ended up making over 20% return in the depths of the recession. We turned around and did it again. We bought some land in Florida that
okay,
had been 160 million in escrow. We
hmm.
bought it for 16 million. We're still selling off those lots today. We bought 4,200 lots in Florida, just north of Tampa.
Did you guys develop any of them, or they were just all lots and then?
We developed the lots. So
Okay,
it was basically designed for a golf course. And my partner just thought, there's enough golf courses in Florida. Let's do something different. So we were one of the first to bring the Crystal Lagoon to the US, where they took what would have been a golf course and we turned it into a water feature. So people
oh
could paddleboard and, kayak and stuff, and not have any alligators because it's so crystal clear. You can see, if there's alligators in there. But it looks like a beach. So we just designed all of that, put in the roads, the infrastructure, and we sell the lots.
wow,
We didn't actually build, we sell to builders, and we're still doing it, but investors have already received the capital back. So now it's just profit. It's been profit for years.
yeah, yeah, yeah. Well, I mean, that's a huge undertaking, I would say, to go from. And how long did that take of, changing it from a golf course to what you guys were going to do is, a lagoon or a lake, or
It
how?
took forever. It took way too long. It took probably 6 years.
Oh, 6 years.
I would never have taken on something like this, but my partner was a 40-year veteran developer. He had done this type of thing plenty of times. So it wasn't overwhelming for him, but it did take longer than any of us thought. But it turns out Florida actually had stricter regulations than we expected in terms
Oh,
of growth. But that, the timing actually turned out pretty good because we're still selling lots at a time when there aren't any, right? And
mm,
costs have gone up so much, and it's a really, really popular area just north of Tampa. So it's actually been quite profitable, even though it's gone on 10 years now. Uh,
yeah.
but the investors are getting 15% pref plus profit, so they're fine with it. They're not upset at all.
Yeah, that's not bad. And I mean, it almost, 6 years kind of sounds like California time frame from, getting something to, entitlements and everything else. It sounds like quite a bit of time, but I would assume on the time you guys bought it and then now, and especially at the price point that you guys bought it, it's still, a very, very good investment. So, so moving forward, we just went through and we're still kind of going through it, the changes in the market, and activity, not price point, but activity has been down, especially last year, past year and a half, 30, 35, 40%, some areas like 45% on buyers and sellers doing any type of transaction. So you know, going through that, and obviously, your experience and pedigree through 08, 9, 10, 11, how do you feel like, and what do you see coming up in the market of this year on, just a market overall picture?
Yeah, it's really easy to want to compare now with 2008, but it couldn't be more different.
Yeah.
That's what people really need to understand is just because prices are high, just because they've reached new peaks, just because sales are down, there's more to the story.
Yeah.
And so just a quick summary of what those main differences are. In 2008, and I was a mortgage broker at the time, so I knew what was happening. Those were bogus loans. Those were liar loans. We know that.
Yeah.
They were also loans where people could qualify at just a teaser rate. So
Yeah.
you didn't even have to qualify for the full loan. It was just like, it was crazy. It made no sense. So of course that all fell apart. That's not the case today. Today you have to, how hard it is to get a loan. You have to show all the documentation, full documentation and more up until the last minute. And then they want more and then more and more. Back then, literally there was none. You didn't have to give any documentation. You'd fill out an application and blah, it was done. So it's much harder. Back then, you didn't even have to have good credit. So you could just fill out a piece of paper, have no documentation, no proof of anything, and have bad credit, have a history of not paying your bills. That's not the case today. People who are getting these loans and having full disclosure loans also have the highest credit in history that we've seen. So they have a history of paying their bills. They've had to put down payments. They have high equity. Wages have gone up. So it couldn't be more different. And they're not, the biggest difference is back then those were adjustable rates. Today they're fixed. People their fixed rate payment on their home is far lower than rent.
Yeah.
Whereas back then, everything adjusted and people couldn't afford to live there. So when people think that there could be a housing crash, they have to keep in mind that even though prices are high, and they are, it's crazy how high they are.
Yeah.
And you would think that following that would be a crash. How could there be a crash when the people who own those homes have the lowest payments in history compared to their income? They have, it's when you look at the chart and all you have to do is look it up, payment to income on the Federal Reserve site, just look Fred mortgage payment to income. You'll see that it is historically the lowest. So homeowners are in the best position they've ever been in. They are sitting on a ton of equity. They are on fixed rates that are low, half of what rent would be, half of what it would be to own that home today. So the problem and the distress is not with the homeowner, it's with the want to be homeowner. It's the person trying to get into the market. That's why sales are down. It doesn't make sense. It's something like 43% cheaper to rent today than to own. So why would you own?
Yeah.
What's the point? So that's until something changes, either wages have to go up dramatically, interest rates have to come down dramatically, or prices have to come down. Otherwise, you have a stuck market, and that's what we have.
Yeah.
There's no concern about more supply, too much supply coming on. The concern is not enough supply.
Yeah.
And can builders bring on new inventory fast enough to solve this problem? If more inventory would come on, then that could soften things. But that's really hard to do. And I'm in the home building business now. It's not easy and it's expensive. It's very, very hard to bring on affordable housing that, somebody that would make sense for somebody to buy it. So what we've seen at Real Wealth, we've had one of the busiest years we've ever had in sales, but we sell to people who are looking for, to buy rental properties, not to live in those homes. And the way that we've made that work is we've negotiated with builders all around the country who were kind of stuck with inventory. And they built all this inventory and then all of a sudden rates went up and they couldn't sell. So we were able to negotiate with a bank where the bank would bring this program to builders to lower rates. The builders would just pay a fee to the bank and get the rates down to 4-5%.
Yeah.
And our investors were all over that. I mean, Rich and I were buying like crazy because we were able to buy duplexes, fourplexes for under 5% interest rate, and we're cash flowing.
Yes.
And those are fixed for 10 years. So there's always ways to work around. The other thing we did as soon as we saw that rates were going to go up is I started a single family rental fund, because I knew that the market would be stuck and the only people who could buy would be people with cash.
Yeah.
So I started a fund, we raised cash from investors, and then we bought homes with no competition. We bought the homes that only investors would buy, homes that have problems. They need a new kitchen, or the bathroom isn't working, or whatever, they're old. There was just like nobody buying those, because flippers or, people who buy old homes and fix them up, they were looking at enormously high interest rates to do that. And it was really, really risky.
Yeah.
But we had cash, so we could just go in, buy for half the price of what they were asking, do the renovation, and put these on the rental market.
Yeah, that's interesting. So when rates went up, I've been taking notes this whole time, but when rates went up, a single family resident fund. So are you guys still buying just specifically in Texas, or are there a couple other states out and maybe Florida that you guys are focused on?
Our rental fund right now is in Dallas. It's north of Dallas, where a lot of that chip manufacturing is coming in, about an hour north, and just enormous amount of jobs coming in. But the homes are still pretty cheap. We're literally buying homes for under 100,000, fixing them up. So they're probably have 120 to 150,000 in them, but the rents are coming in over 1% of that. So really strong rents in this area where massive tech jobs are coming in, people with high salaries who could easily afford the rent that we're offering for these fully renovated homes that are nice. They're on older streets with old trees. I mean, just really beautiful neighborhoods. So Florida has been our main focus. We're going to be doing Florida. I mean, Texas has been our focus, but we've been helping investors build their own portfolios all around the country, not just Dallas.
Okay. So you guys help those and guide those people that are looking, in the Midwest or anything like that. So you can kind of, guide them as a coach through that process.
Yeah.
And have you been doing that for the whole time as well with Real Wealth, or is that something new where you've been able to guide people through, hey, this is a good area, this is what I would be looking for?
Oh, no, that's been our business model for 20 years, ever since Rich and I jumped on a plane and went to Dallas. I came back, talked about it. My show it's a podcast, but back then it was actually a radio show in San Francisco.
Oh,
so nice. I would just talk about it. I'd come back and get on my radio show and talk about how I just got back from Dallas and bought some properties, and they rented out for more than 1% of the purchase price, and they stayed rented, and they were I would just talk about it. Yeah. And our phones would ring off the hook with people saying, oh, tell me how I can do that. Who did you work with? Who is your realtor? Who is the builder? And I was a mortgage broker at the time, so I would do the loans. But then I realized I could also, work with real estate agents as a referral-based business. So that's what we still do today. Is we'll go to an area where Rich and I want to invest. Okay. We'll get our team completely set up with, the lender, the property manager, the realtor, and so forth, and then we package that so that our investors have everything they need, and then we just receive a referral fee, broker to broker, because we're licensed in California.
That's huge. Yeah, that's very smart to do that. Especially being able to, walk them through everything and then introduce them to the person that's going to be, tangible there when, they're going to invest. So talk to me about, raising some money for single family residents. I know you guys have done other stuff, but talk to me a little bit about that. Just, when you're doing the fund, what type of situation for me, if I'm a brand new investor and I don't want to go do this on my own, what would you tell me? Like, hey, what am I looking at for that type of fund? Are there questions I should be asking and everything else?
Well, first of all, the SEC regulates syndications and funds. So it's not the Department of Real Estate, although I'm sure they regulate it in some ways, but the raising money part, bringing investors in, is regulated by the Securities Exchange. So in this particular fund, you have to be accredited. Mm-hmm. That's just one of the requirements for me to be able to talk about it on a show like this. The only way I can is if investors who invest are all accredited. And what that means is they either earn $200,000 as an individual or $300,000 as a married couple for the past 2 years, or they have $1 million net worth, excluding their residence, or they are licensed, with the Series 7 or some of the other securities licenses that counts too. It's accredited. So that's first.
Okay.
Then I would say just kind of looking at the experience of the people running the fund. I've had so many people come up to me at events saying, I want to syndicate, I'm just getting started. I'm like, you're going to take other people's money when you haven't actually invested yourself. That's a terrible idea.
Yeah.
You unless your partner has an enormous amount of experience, you should never take other people's money unless you really have a track record. So that's what I would look at. My partner lives in Dallas. She invests there. She has a $40 million portfolio herself. She's a property manager, so no one could probably know the area better than her.
Yeah.
And she has her full teams for renovation, and she's got her wholesale network, so she's getting these incredible deals you wouldn't be able to get otherwise. So just again, the track record, experience, who's running the syndication, and then finally, just kind of what the splits are, making sure that I've seen different kinds of splits where it just needs to make sense to you. What are the fees? We charge a 4% fee, which is pretty high for acquisition, but that's because we're including the cost of us renovating the properties. We're not charging for that.
Yeah.
But I've seen people charge a 7% fee for what? It's like that's a huge amount of money. And then expenses, like what are they allowed to spend your money on? And I actually had a guy come to me from Wall Street who wanted to do a single family rental fund, and he wanted to pay himself like a $500,000 salary. Like, absolutely not. No, you get your money through a normal fee and through the profit at the end, but investors have to get their capital back first, and they have to get their preferred return first, and then you can get your profit.
Yes. Yeah.
I've seen guys try to pay for their private jets, through the investor funds. And if that's written in the documents, they can do it.
Yeah, they can do it. Yeah. As long as obviously all that stuff's disclosed and people sign off on it and agree to it, there's mutual consent. So, okay, so you have 7%, 4%. What's an average fee if someone's going to go out there? Obviously, you guys are doing all the rehab, and you guys are putting a lot more work into it. But if you're looking for an average amount, is that a good basis? 4%, 3%, and then also. Speaking of experience, there's people that have 2 years experience or 4 years experience or 40 years experience. Where does that kind of pepper into qualifying these people to throw your money at?
Yes, such great questions. Normally, an acquisition fee is 1% to 2%. An asset management fee is 1% to 2%. There might be a disposition fee, again, 1% to 2%. There might be a fee for if you're the person who's signing for the loan. Those are all pretty standard fees. It's when it's really looking at the expenses too. Are you going to pay for their whole office, their employees? That needs, just make sure you really read that carefully. Okay. In my opinion, the asset management fee should be enough. You shouldn't have to pay for their receptionist or whatever. That should just kind of come out of that. But it just depends. Like if the profit is so high, we're doing an entitlement deal right now with the guy that I've been working, my partner that I did that Portland deal with, 15 years ago. Yeah. He's just brought me another one because this is his market. When there's distress, he's all over it.
Yeah.
There's certainly distress in commercial real estate because it's on adjustable loans. Yes. Just like residential was in 2008, commercial is today on those adjustable loans that have reset and are throwing all the numbers off. So lots of distress there. He has found some land outside of San Francisco, and we are re-entitling it from farmland to residential and then just selling off those lots again. Wow. Similar business plan. The profit is so enormous that the fees are a bit higher. He is paying himself a salary because the work of entitling really requires so much expertise and time.
Yes.
So he's getting a salary, and that literally that that syndication filled up in one webinar because the profits could be so high that it's kind of worth it for people. So just, it just depends on the project, really, what those fees should be. And as far as experience, like I said, my partner in development has 40 years experience. Development's hard and complicated. I thought that, when I first worked with him, I thought, gosh, this is great. The profits are so great. When another developer came to me, I syndicated a deal with a different developer who had less experience, and those have been very difficult. Some have had investor losses. And I'm just being honest, the more experience, the better. Let's put it that way. The more experience, the better. If people haven't been through a down market, they how could they know? And over the past 10 years, many of the syndicators today, many of the real estate experts have not been through a down market. They are now. They'll soon be real experts.
Yeah, especially the ones in commercial.
Yeah.
Yeah, definitely the ones in commercial. So no, those are good tips. I mean, you have a wealth of knowledge, especially going through what you've gone through and the businesses you've built, and the markets you've been in. So that gives a lot of good points of recommendation for people that are going out and they're 2 years in the business or even 10 years in the business. That gives a lot of backing to them. So before my last couple of questions, just 1 minute. We don't have to get into the weeds on it. We can, but 1 minute prediction on this year's market. What do you think? What do you think is going to happen?
Well, in residential, you have a lot of pent-up demand. You have a massive group of millennials. Again, comparing now to 2008, you had Gen Xers. It's a very small generation that was in first-time home buying age. Today, you have far less inventory, a fourth of the inventory that was available then, but a much bigger group, much, much bigger. The millennials are massive. And now you've got Gen Z right behind them. Wanting to buy a home. So pent-up demand. You've got very limited supply. You've had some decent wage growth over the last few years. So now that interest rates are coming down, there's just going to be a frenzy, in my opinion, in the housing market. There's going to be people jumping in. I expect bidding wars again. I expect prices to go up. I would say that that's a little bit different than some of the predictions at Zillow and some other, forecasters who think that the housing market will be pretty flat. I don't think so. Every time we've seen interest rates come down, we've seen a frenzy. So I think that's what we'll see. We've seen the Federal Reserve say that they're going to reverse what they've been doing and start to lower interest rates, and that is a stimulus to the economy. So, job growth has been so strong. The number of job openings, there'll be less. But I actually see a really robust year in 2024.
Yeah, and I mean, even with the market where they've even talked about it, obviously, being your experience as a lender for so many years, even talking about lowering the interest rates has helped the bond market already. The past month, it's gone down significantly. I've gotten some clients into escrows at 5.75% on FHA loans, single family. So it's gone down significantly. And so, even the conversation and everything else, as the feds say, hey, I'm going to raise the rates, that's going to affect the bond market. And the rates are going to go up just to make sure they price that in, and vice versa. And then also, to continue to talk about what you talked about, is the inventory is still so low that that demand pent up going after low inventory is just going to boost those prices even more, which I agree. Even with us not being at 2.5%, 3% interest rates, it's still going to boost that demand significantly. So, well, Kathy, a couple last questions. One, do you have a book that has helped you throughout the years, and what book would you suggest someone to read?
One of the first books that sort of changed my thoughts about money is The Science of Getting Rich.
Okay.
It's an older book, but it just takes away some of the guilt you might feel about having wealth. And I see that out there. there's oftentimes and definitely a theme among young people that wealthy people are evil and, all that goes along with that. And when I learned that, when I read The Signs of Getting Rich, it was like, oh my gosh, how much more powerful can you be when you have more to give? When you can help people in need and when you can donate and have the resources. So it's just a different take on that and more motivating to want to create that portfolio.
Yeah. I have not read that book, but I'll definitely read that book. What about one tool or app or online resource that you're using in your business today that's making you more efficient?
We have used dealcheck.io. That's pretty cool. I like that. That kind of helps you uh, put your portfolio together to understand your numbers and what to buy next.
Yeah.
Um, we also use within our company, we use Basecamp. That's a organizational system.
Heard that.
It's just a place where everybody can put their projects and be able to stay connected.
Is it kind of like a Monday.com? Is that what
Maybe,
Okay.
yeah. Mhm.
Okay, cool. And then also, where can people find out more about you?
Oh yeah, my podcast is The Real Wealth Show. My book is Retire Rich with Rentals, and our website is realwealth.com. It's free to join. We have over 500 free webinars on how to save money in taxes, how to get great asset protection, how to find the right markets, all kinds of information. And then, of course, a referral list to teams that we've worked with for the past 10 years who can help you build your portfolio.
That's awesome. I wrote all that stuff down, so I'll make sure that we note it in the show notes, as well as, um, I'll talk about a little bit on the intro. But outside of that, I really appreciate you coming on, and I appreciate you kind of diving into a couple of things, especially your background, your experience through 2008, the vulnerable, scenarios, and bringing us up to speed on what you're doing today. I really appreciate it. Thanks, Kathy.
Thank you so much for having me on.